Hey, this is Greg. Welcome to DLA Markets. It's been a while since I've done a market update, but the reason I decided to do it today is because there has been a sentiment change in the market, which I think is going to dramatically affect the stock market. And we could be in for some really rough sailing and potentially a big market sell off in the next couple of months. And I want to tell you about it. So stay tuned on this broadcast because we're going to go into it right now. All right. Well, welcome to everybody. Thanks for joining. And I haven't done many market updates recently, but I was waiting for an opportunity where I could say something really meaningful. And that opportunity has come in the last couple of weeks as things have developed. Okay. So just to start off, let's review what's happened in the market just briefly since the beginning of the year. Okay, so it's no secret that the Nasdaq and the broader market has basically rallied since the beginning of the year, right? And if you look at this chart, you can see what the Nasdaq's done. It's gone pretty much nothing but up, except the last couple weeks. And at one point, it was up 30%, led by the FANG stocks, and the S&P had a similar run. But the thing is that, particularly in the Nasdaq, in my opinion, it was driven by basically three basic things, right? One is multiple expansion, right? You saw that particularly in the FANG stocks and the big cap tech stocks. The soft landing narrative that everybody's been talking about, right? CNBC, no matter where you go, on television, every single day, everybody's talking about a soft landing, soft landing, soft landing. Everything's going to be all right. We're not going to have a recession. All right. So that drove the market. And also, prominently, AI speculation. In other words, this belief that AI was going to, bail out every small tech stock, mid-sized tech stock, and was going to contribute to the growth of every large tech stock. It's kind of like the AI was like sort of like the fairy godmother of the market, and it was going to come to rescue everyone and push valuations to unseen levels. Okay. So these basic three things have guided the market. And also, if you look at, for example, the S&P 500, you see a very similar situation, as you can see here. The S&P hasn't gone up, which is the broader market, hasn't gone up quite as much as the NASDAQ, but it definitely rallied. And as you can see at the tail end of this chart, in the last couple of weeks, things have started to fall apart. And that's what we're basically going to talk about, the causes for that and the reasons for why I think there could be a big sell-off coming in September and October of this year, which is seasonally, as you know, always a weak time in the market. Okay, so let's talk for a second about this, what I call the CP lie. Okay, here you see the CP lie. Let me just, you can see a little bit better this way. You can see that, and I'm going to put the old glasses on here so I can see better, right? Um, Basically, my whole premise here, I'll give it to you up front, is that yes, it appears to everyone that CPI or CP lie, because I think the government's numbers are bullshit, but CP lie has been generally coming down from the 9.1 to the 3%, right, last month, and then this month the overall CPI came in at 3.2. So it went up slightly, but it's still, in the perception of the market, still coming down. Now, core CPI, which is what I focus on a lot more and what the Fed focuses on a lot more, is at 4.7, which was down slightly from the 4.8 the previous month, right? So people are starting to feel better about inflation, but as usual, the devil is always within the details. So my basic premise is that the only reason CPI has gone down is because of declining energy costs. Okay, that's the main reason. There are other reasons. The goods part of the goods and services in the GDP has also been coming down. And we'll talk about services in a minute. But if you look at this chart, you can see very clearly that what's basically happening here is if you look at energy, okay? Energy down 12.5%, right? You look at that's energy commodities rather. Then you look at gasoline down 20%. You look at fuel oil down 19%. You look at energy services down 26.5%. But yet you go down here further and you see shelter 7.8% up, 7.8%, and transportation services down 9%. Now, the thing you have to understand about the recent numbers is if you've been following, as I have, energy prices, okay, energy prices have been going up. Oil is over $80 a barrel right now on WTI. Uh, Gas prices have been going up. Gasoline prices have been going up. They've all been going up. And so, what basically isn't being captured in these numbers is the rising energy costs. And as we get to the next period, which will be August, these numbers will begin to show up. And people are beginning to realize that not only are services still very high and going up, but now energy is continuing to rise, and it's going to continue to affect the CPI number next month. All right, so CPI can be expected to go up from here. Let's take a look at this. Okay, this is the CPI. You can see here again we have a situation where you can see, look at services. This is ridiculous. This is a incredible continued increase in services. You can see that the goods have gone down, right? Now, when you drill into the services, you can see what is really driving this increase. And you can see, now this is PPI. Now, PPI is um, instead of a lagging indicator like the CPI, PPI tends to be um, an indicator that shows what might happen in the future, a leading indicator. So you can see that when you look at the breakdown of these services, you can see trade services, transportation, and warehousing is up dramatically. Trade services is up. Trade is up dramatically. And when you look at that, you can see that the CPI is certainly not going down. It's continuing to go up when you look at the components. So I think what we can draw from this is that when you look at energy, when you look at services, you still have the potential for rising inflation. And I think the market is just now beginning to understand this. Um, the other thing that strikes me very intensely, hold on one second. The other thing that strikes me very intensely when I look at this is that labor. Now, labor is also tied to the employment picture, but let's talk about labor first. Labor is insanely pressuring upward. Okay, now this has been happening for a long time, but because of the tight labor market, the labor unions have been pressing business to increase wages. And this increase in wages has become a real issue. Okay. And, you know, here you see an example of it. Basically, the Teamsters just recently basically put one of the oldest trucking companies in the United States out of business. This Yellow Corp trucking company was an over 100-year-old company, and basically, put them out of business, right? And so this is really crazy because it's happening all over the place. Okay, it's happening in UPS. They just got an incredible increase in their wages through their union. It's happened at FedEx. The Teamsters are doing it all over the place. And what this does is it puts upward pressure on inflation. Labor is a big component of everything in the economy. Obviously, you can't produce goods and services without labor. So this is something that we all have to keep an eye on, and it argues against the viewpoint that inflation is coming down. In the case of labor, we have seen no indication of that. Okay. Now we move over here to unemployment. Okay. And let me get this right. Okay. Here you see unemployment. Now, unemployment is 3.5%. Okay. That means everybody's working. Okay. And when everybody's working, everybody's spending. And when everybody's spending, the economy is booming. Okay. Now you couple that with my favorite subject where I always talk about this on the whether it's on a podcast or on the real channel. And by the way, if you're getting value out of this, please hit that like button. Okay. It helps me out a lot. And it gets the podcast and the videos out to other people. But my favorite thing to talk about is this tight labor market, and the fact that everybody's working is combined with the fact that the government, the Joe Biden administration, since they came in, has flushed or is in the process of flushing $5 to $6 trillion of additional deficit spending, right? Because it's all borrowed money. This is not money that we're just taking out of the treasury. This is all borrowed money. So they're borrowing money, they're flushing it into the system with the infrastructure plan, the inflation reduction plan, which is a joke. Everybody knows it's a joke. It was the Green New Deal plan. That's all it was. And a lot of people are going to get rich off that, but it's not you and it's not me, unless you're in the green energy business. But those two things combined, the tight labor market, and they're related, by the way, because remember, government spending is 35% of GDP. So when the government flushes all this deficit spending into the system, it's going to increase economic activity, it's going to increase jobs, it's going to increase everything. Except the downside is it increases the deficit and it increases the amount of debt that the country has. But that's another discussion. Now, let's look at some of the other things I have here. Let's see. Okay. So, another effect that people have started to focus on this week is what's going on in the bond market. Now, here is the 10-year Treasury, and let's take a better look at it. The 10-year Treasury is at almost 4.25%. It's one of the highest rates that we've seen in something like 25 years. The Wall Street investors are finally starting to take notice of what's going on in the bond market. And for anyone who's watched this channel, I've also talked about the shorter end of the curve, which you can see here in the 3-month T-bill. And this 3-month T-bill is also historically high. And this is why we've talked about that cash is actually your friend in this market, because I can put idle cash into the short-term treasury market at 5.44%. I mean, that's a freaking no-brainer. If you believe inflation is 3.2%, that means I'm getting a positive real rate of return. Of course, I don't believe that because there's no way you can convince me that the cost of me living is only going up by 3.2%. That's patently ridiculous. But that's what the government's trying to make us believe. But having said that, idle cash is definitely valuable in this market because you can make a riskless rate of return of 5.44%. That's something to sit up and take notice of. So as we look at where we are now, and as we look at my basic thesis on what's going on in the market, um, I think several things are finally dawning on equity investors. Okay, the first thing is that the economy is currently strong and inflation is not coming down. Okay, in fact, now remember when inflation goes from 5% to 3%, that doesn't mean inflation's going down. Inflation's still rising at 3%. In other words, prices are still rising at 3%. So it's just they're rising less fast than they were before. Okay. So that's important to keep in mind. But what people are beginning to realize is, oh, I guess the Fed's not going to be reducing rates anytime soon. And in fact, rates are going to stay higher for longer than most people think. And I've been saying this for some time. And in fact, what I'd like you to do is go back and look at some of my videos that I did 6 months ago. And I've been saying this for at least 6 months, maybe 8 months, that interest rates are going to stay higher for longer than most people think. And soft landing or no landing is the worst possible thing that could happen because if that happens, the Fed's going to continue keeping interest rates high. Whether they'll increase them dramatically from here is yet to be seen, but they're going to at least keep them high. And guys, there's not going to be any lower interest rates for probably the next couple of years. And in fact, Powell, and I have a picture of him here. Where are we here? Let's get over here. And as I affectionately call him, Clown Powell, in some of my previous videos, Clown Powell even said in his last speech that he doesn't expect to get to the 2% inflation target till 2025. Isn't that a great message? So all of this stuff is starting to sink in, and it basically is eliminating any hope that rates are going down anytime soon. Okay. So let's keep Clown Powell up there for a little while. I like that. Let's see. What did I do here? Okay. Let's keep him over there. Let's just keep him in our consciousness for a period of time while I go through the rest of my presentation here. But I think that there are several other factors aside from the ones that I just went over that I want to talk about. One is, I think, continuing geopolitical risk. It looks like China's imploding, guys. Okay. It looks like their economy is in the crapper. You have 30%, young people unemployment. Their economy is just, and if you believe the numbers coming out of China, I got some marshland to say in Florida. So don't believe those numbers. They're completely made up numbers. They're worse than the made up US numbers. Their economy's tanking. And this uh, does provide a risk to the market. And Evergrande, which is a real estate development company, just recently announced that they were going bankrupt. Okay, finally, after all these years, finally they're going bankrupt. But I believe in China, this is just the tip of the iceberg. So keep an eye on China. That is a continued geopolitical risk. Of course, you have the war in Ukraine that continues to weigh on energy and cause energy to be high. That's going to continue. So we have that. Um, the uh, the fear of a recession seems to be fading, and that ironically is bad for investors and bad for the stock market. And the reason it's bad is um, if you don't have a recession and if the Fed doesn't crush the labor market, the Fed's going to continue to raise rates, or at least they're going to continue to keep rates high. Okay, so this idea of oh, we're not going to go imminently into a recession and a soft landing or a no landing, that's actually bad for the market. Okay, and the other thing that I think is particularly bad for the Nasdaq and for the FANG stocks is that I think this AI hype that was centered around NVIDIA's rapid rise when they announced that they were going to have $11 billion in sales the next quarter, which is yet to be seen if that even happens. Um, that sort of ignited a whole AI hype that affected every FANG stock and every high tech stock that had anything to do even remotely with AI. I think that whole hype is fading, and that is going to put further pressure on the tech stocks, okay, and therefore the Nasdaq. Now, I think the conclusion here and the message I really wanted uh, to hit home, along with Clown Powell over here, my friend Clown Powell over here. I would say continue to keep your powder dry. Um, I think we're heading into a period where the bond market is going to start convulsing with all of this news that's coming out, and with kind of a resurgence in inflation. Um, Rates are going to stay higher for longer, and as the prospect or the hope among equity investors continues to fade that there's going to be any near term or even intermediate term decrease in rates, that's going to throw a lot of cold water on any bullishness that we've seen in the, say, the last 3 to 6 months. Okay. Um, I think the bond market is going to continue to contribute to a sell off as yields go higher. Of course, they're not just going to go straight up and go, the 10 year is not going to just continue to go straight up higher, which means bond prices are going down. But uh, there'll be ups and downs, but the overall trend could be really nasty in the October, November timeframe. And remember, going back to really even the 87 stock crash, frequently stock market crashes are preceded by bond market crashes. Okay. So keep that in mind. I would keep an eye on the bond market more than anything else. I would I would keep your powder dry. I would continue to watch the channel as I continue to give updates. And by the way, please like and subscribe if you got value out of this. And I think we can all expect rates to stay higher for longer than most people think. And this is generally going to be bad for the investing environment. And I think we're going to hit a very rough patch in the September and October timeframe coming up. Okay. Well, I hope you got value out of this update. And if you did, please like and subscribe if you haven't already subscribed. And we do content on this channel involving the markets, the economy, specific stock tips, everything that you need to know to become a better and hopefully richer investor. Okay, so thanks for watching, and I'll see you on the next video.